Hi, I'm Jenny Brown. Welcome to this week's MFB News. Hope everybody is really well and had a lovely week. What have we got for you this time around? So thankfully, at last, we have seen some pricing movements downwards on fixed rates. We've been talking about swap rates over the last few weeks, discussing the fact they've been edging back down. They were at 3.82% at 11 o'clock last night, which is much lower than the 5.2 they peaked out at after the mini budget. So how does this kind of impact mortgage pricing? What's been going on? We've seen some fixed rates come down, and I'll go into that in a bit more detail in a moment, and also give you some views about what's going to happen, what kind of direction of travel we're on now. I'm then going to run through the latest news from the Halifax House Price Index and then share some data that's been released with regards to tenant repossessions, which I think makes some very interesting reading. Okay, so as we were hoping last week, we have started to see lenders, or some lenders, reduce their fixed rates in response to the lower cost of funds on the wholesale markets, the swap rates essentially coming down. So as I just mentioned, as of 11 o'clock last night, 5-year swaps were at 3.82%, so travelling down. In previous weeks, we've been hovering at the 4.2 mark. Post mini budget, we're at 5.2. So essentially, you've seen a 1.4% reduction on 5-year cost of funds, and now this is starting to feed through in terms of lender pricing. Now, not every lender has slashed their rates, and even those that have made reductions aren't necessarily making 1.4% reductions, but we are starting to see things ease off. In terms of how I see this shaping up over the coming weeks, I think we're going to continue to see the lenders that haven't yet made reductions on their pricing start to reduce their fixed rates as well. And then once we've got the autumn statement out of the way, where there hopefully will be no clangers which are going to totally rock the money markets and send things shooting back up again, then we should see further rate reductions going forwards. So the first bit of great news was that earlier this week, today's Friday, we got an email from Paragon Mortgages telling us they were bringing out a new rate. Now, this rate, it's tragic really. I mean, I never thought I'd get excited about a rate that started with a 5, but actually, given where we are at the moment, this rate is incredibly competitive. So Paragon have released a 5-year fixed rate at 5.69%. It's got a 2% arrangement fee. It's available to 70% loan to value. There's an application fee of £299, but you do get a free valuation. Now, the reason this rate is particularly interesting is because Paragon are able to lend on slightly more complicated sort of structures, arrangements. So no limited number of background properties in your portfolio. Income, they need you to earn £25,000 a year, but it can be from rental profits. They can lend to limited companies, layered limited companies, HMOs of up to 20 bedrooms, multi-units of up to 20 self-contained units. And they can also just sort of take a view on slightly more complicated things. Now, in terms of where this sits in the market on this kind of more specialist side of things, 5.69 is incredibly competitive. So we're super pleased to see that come out earlier this week. Now, in terms of what other lenders have been doing, we have seen the Mortgage Works make reductions to their pricing. Now, the Mortgage Works are a huge lender. They're owned by the Nationwide Building Society. Whenever they make a big change, obviously other lenders need to react to that. They'll be looking at their product set and thinking, well, hang on a minute, how are we now placed? So they now have tracker rates from 3.09, 2-year fixed from 4.59, and 5-year fixed rates from 4.99. The reason these rates will be cheaper than the Paragon one I've just mentioned is because the Mortgage Works offering, this is for people with less than 10 buy-to-lets in their portfolio. It's not for HMOs, it's not for multi-units, and it's certainly not for limited company lending. So there you go. Barclays have made reductions of some of their rates of up to 14 basis points, so 0.14%. We've seen NatWest reduce some of their 2-year fixed rates by 0.5%. Accord have made reductions across selected fixed rates by up to 0.55%. Now, they've interestingly also rebought out, I should say, a fixed rate with no early repayment charges. Now, the rates here are from 6.26%, so not incredibly exciting, but actually for some people who dread the thought of taking a variable product, they really just don't like the uncertainty of that, but they also think that rates are going to come down, and actually locking in on a fixed rate of 6.26 or above, depending on your loan to values and other criteria, just to kind of ride things out for now, but knowing you can exit at any time, could be a really nice option for you. Now, Accord are a lender who lend only to individuals. They're not doing anything racy, no HMOs, no multi-units, but if you are a landlord with less than 10 or less buy-to-let properties in your portfolio, that could be a really nice option for you. We've seen West One reduce their rental calculations. So what they've been doing is saying that the rental coverage, if you're an individual, will be 145%. If you're a limited company, it's 125%. coverage at 7.25%. They've now reduced that down to 6.75%, and I'll come on to the rental calculations again in a minute because we've been chatting a lot about that in the last few weeks. We've seen the Skipton actually reduce some of their fixed rates by up to 29 basis points. We've seen Landbay relaunch green mortgages, so mortgages for properties with EPC ratings of A to C. Now, the reason this is interesting is that in the last few months, where margins have been so kind of restricted, so lenders have been having to pay a lot more money for the kind of funds that they're bringing in to lend back out to you guys. What they're not being able to do is offer really incentives for greener properties because the margins are so skinny anyway. So the fact that Landbay are now reintroducing something where there's a preferential rate for a green property is really, really encouraging. Now, they've also changed their rental calculation on their 5-year fixed rates, and they have also reintroduced lending to trading limited companies, so companies that don't just rent out properties, that has another income source, be that I don't know, IT consultancy, dentistry, whatever it is, but a company which isn't just a property holding company. We've also seen them reduce their rates by up to 25 basis points on their multi-unit and HMO ranges. We've seen Molo reduce their fixed rates by 0.5%, and we've seen the Yorkshire Building Society reduce their rates by 0.45% as well. So really, really encouraging in terms of pricing movements on the market. Now, are we down to a point or at the bottom of the reductions? I don't actually think we are. I think we've still got time to go, as I mentioned earlier. I feel that lenders have actually recognised the cost of funds have come down. They're comfortable that we're on a kind of downward direction of travel. I do think actually that probably you're going to see things bottom and level out from the kind of end of November, start of December. Like I say, once we've got the autumn statement out of the way and everyone knows there's going to be no nasties hidden in there which are going to kind of throw things out of the water again. So where's this left us in terms of pricing across the market? So currently, it's a very, very vanilla deal. So individual ownership structure, no HMOs, no limited companies, sorry, multi-units, 2-year fixed rates from 4.59, 5 years from 4.99, and products with no early repayment charges, so a variable rate with no ERCs. Definitely worth considering if you're faced with paying a standard variable rate of 7.5%, even 8.5% for some people, just to bring your costs down for now while they kind of ride out the next couple of months. So no ERC rates from 3.99%. Limited company pricings, 2-year fixes from 5.69, 5-year rates also from 5.69, we've talked about that one today, and again, no early repayment charge products from 3.99%. And what's really interesting here actually is if you look at the pricing difference between personal and limited company, normally we look at between 1 and 1.5% pricing difference. At the moment, we're looking at really more like 0.7 to 1%, so a much more constricted difference between the two right now. In terms of rental calculations, so it's kind of going in two totally different directions actually. So for those lenders who are doing on 5-year fixed rates a rental calculation which is related to the interest rate you're actually taking, so we would use the terminology pay rate. So as an example, I'm taking my 5-year fixed rate of Paragon at 5.69. Then what Paragon would be saying is, okay, well, our rental calculation therefore would be 125 for companies or 145% for individuals against an interest rate of 5.69%. So they're using the actual rate you're going to be paying. Now, because 5-year fixed rates have been up in the mid-6s, that's been really kind of scuppering the rental calculation for lots of people. So by bringing out a lower fixed rate, the rental calculation eases, which means you can borrow more per pound of rental incomes. This is really, really good. Now, conversely, for those products which are variable, so trackers, discounted rates, also 2 and 3 year fixed rates, the lenders have increased their rental calculations. It's kind of gone the other way. So whereas in the last few weeks, weirdly, you could borrow more on a tracker than you could a 5-year fixed rate, it's really starting to turn. And this is really kind of the direction of travel, I think, at the moment in terms of where we're going. So really, really great news. Fixed rate pricing is starting to come down. I don't think it's at the bottom yet, but we're definitely going in the right direction. There are actually some quite attractive deals available. I do think we need to get used to the new normal of interest rates, 5-year fixed rates starting with a 5 for very, very straightforward deals, starting with a 4. Those days where they started with a 1 or a 2 are definitely well behind us now, but really, really good news this week. Okay, now the Halifax has released its latest house price index, and this has shown that house prices, the average house price, fell by 0.4% in October, which is the third decrease in the past 4 months. Now what they're saying is the drop of 0.4% is the sharpest recorded since February 2021, taking a typical property price to a 5-month low of $292,400. £598. They said that while the pace of annual growth continued to ease to 8.3% compared to 9.8% in September, average prices remain near record highs. They have said that property price inflation weakened across all buyer types during October, with annual price growth amongst homeowners falling to 8.9% from 10.3% in September. Now, in their report, they do talk about various regional differences, with certain areas sort of holding firm much more firmly than other areas. I think the southeast is really the area which is seeing the largest challenge at the moment. However, what they did go on to say, and this is a quote from Kinnaird, I think this is the surname is pronounced, who is the director of Halifax Mortgages, that through the recent period of rapid house price inflation is probably at an end. It's important to keep this in context with the average property prices rising more than £22,000 in the last 12 months and by almost £60,000 over the last 3 years, which is significant. So essentially, I think what they're saying is, yes, you know what, house prices are starting to, the growth is slowing right down. Actually, we're going to be ending the year at a kind of lower level of growth than we would have been had we been on the same direction of travel, the same trajectory as we were earlier this year. But fundamentally, if you look at a longer period of time, be it 12 months or a few years, actually house prices are still significantly higher than they were previously. And there's been some data that's been released with regards to landlord possessions, so landlords repossessing their properties, and the numbers are clearly increasing actually. So landlord possessions have grown, with claims more than doubling to 21,012 in Q3 of 2022. Orders increased from 5,601 in Q3 last year to 15,352 now, and warrants rose from 4,553 to 8,505 over the same period. Repossessions went up by 10% to 5,403. The median average time from claim to landlord repossession has fallen to 22.3 weeks compared to 68.6 weeks in the same period in 2021. For those who are listening to this, who are also keeping in mind the abolishment of Section 21, this makes pretty horrifying reading actually when you look at the time frames involved. Now obviously 68.6 weeks in 2021 is factoring in the issues with regards to repossessing because of the courts in the fallout of COVID, but nonetheless even now 22.3 weeks is absolutely enormous. Now, the majority of the highest landlord possession claim rates were found in London, with 9 of the 10 highest rates occurring in this region. Brent had the highest rate at 325 repossessions per 100,000 households. This was followed by Newham at 295 and Ealing at 284. Landlord repossessions were the highest in Greenwich at 69 per 100,000 households, and 6 out of the 10 highest rates were located in London. Now, a gentleman called Dan Wilson-Craw, who's Deputy Director at Generation Rent, has said that private renters are under stress like never before. He said that the rising cost of living has pushed thousands into rent arrears who now face homelessness as their landlords seek evictions. Even staying on top of rent is not enough for other renters whose landlords are using Section 21 eviction notices to force them out without needing a reason. These properties will often end up back on the market at a much higher rent. So there you go. I'm not going to offer up an opinion on this one actually. I think it's a very, very difficult balancing act. We are hearing some people saying it's really unfair that landlords are pushing up rents with the cost of living going up. But actually, there is a kind of balanced view on that, saying that the reality is that everyone's costs are going up. If you owned your home, your costs would be going up. So why should it be any different for tenants? I don't know, the jury's out on that one, but there's obviously always two sides to every discussion. But I think, the thing that as landlords we need to be mainly focusing on is the fact that actually tenants are feeling strain in terms of paying their rents, and repossessions are starting to increase, which is never going to be a great thing as a landlord wanting to hear. The good news is that actually, if you do have to evict a tenant, which no one wants to do, but if you do have to do that, then actually tenant demand is increasing. So actually, reletting your property should be a relatively quick experience, and also probably you will be able to command higher rental income next time around. And that's everything for me this week. So look, you know what, actually, there's a lot of bad news around at the moment, a lot of kind of worry and anxiety. But it's really, really great to see that at least we're starting to see fixed rates ease back down. That's going to help people out in some way, shape or form, given the current climate. If you have any questions, do give us a call, 0345 345 6788, or take a nosy at our website. I wish you all a wonderful weekend, and I will catch you same time next week.